Escrow requirements. If a bank requires the escrow of taxes, insurance premiums, fees, or other charges for a loan secured by residential real estate or mobile home, the bank must also collect flood insurance premiums and hold them in escrow. Escrow accounts are subject to RESPA limitations. Covers loans that are made, increased, renewed, or extended on or after October of 1996. The insurance requirements. Banks must require flood insurance on each designated loan, not only at the time it is made, but throughout its term. A loan cannot be made, increased, extended, or renewed if flood insurance is not enforced on the improved real property. Insurance amount must be equal to the lesser of the outstanding principal of the loan, the insurable value of the property, or the maximum limits of available coverage. Coverage is required only for the value of structures. Lenders must have proof of insurance, copy of insurance application with proof that full premium has been paid, or the declarations page from the flood insurance. FEMA will not accept certificates of insurance except on renewals only or binders. If the borrower on a designated loan cannot or refuses to provide the required amount of flood insurance or allows coverage to lapse during the loan term, a bank must force place insurance on the expiration of 45 days from the notification. The bank may charge the cost of the insurance to the borrower. Banks are not required to do portfolio reviews to identify uninsured or underinsured loans, nor do banks have to track map changes. However, if a bank discovers an uninsured or underinsured loan, it must notify the borrower and force place insurance if necessary. If collateral for a loan is improved real property and its contents, for example, a bookstore and its inventory, then insurance is required on the building and its contents if it is located in an SFHA in a community where insurance is available. Multiple structures. Where there is more than one building in an SFHA that secures a loan, the lender must determine the amount required on each building and add them together for the total amount of insurance required. Construction loans. Buildings in the course of construction are insurable unless construction has been halted for more than 90 days and or if the lowest floor is below the base flood elevation. Materials for construction are not insurable until they are contained in an enclosed building on the premises or adjacent to the premises. Lenders may comply with the mandatory flood insurance purchase requirement for construction loans by requiring the purchase of flood insurance for property located in SFHA at the time of loan origination, allowing the borrower to defer the purchase of flood insurance until either a foundation slab has been poured or an elevation certificate issued, or in the case of a building where the lowest floor is below the BFE when it is walled and roofed, if the lender selects this approach, controls must be in place to ensure that the borrower obtains insurance no later than when the foundation is poured or the elevation certificate is issued. For condominium loans, a condominium may be separately insured or insured under Residential Condominium Building Association Policy in RCBAP. Maximum amount of insurance for an RCBAP is either 100% of the replacement cost value of the building or the total number of units in the building times $250,000. Flood insurance requirements for condominiums is the lesser of the outstanding principal balance. The maximum limit for the residential condominium unit or the insurable value for the residential condominium unit the insurable value to the unit, that replacement cost value of the building divided by the number of units in the building. Borrower disputes about flood insurance. Property owners may not contest a lender's policy requirement. Owners and lenders may jointly request that FEMA review a flood hazard determination. If the building is naturally above the base flood elevation, the property owner can submit scientific or technical information to FEMA to prove that the property is incorrectly included in an SFHA. If it agrees, FEMA will issue a letter of map amendment, a LOMA. Lenders are bound by the FEMA maps until a LOMA is issued. If the community approves and initiates a request that indicates the property, a letter request that indicates the property is no longer in an SFHA because of the grade or fill of the site, FEMA can issue a letter of map revision, a LOMR. If FEMA does not change the insurance as a condition of the loan, flood insurance must be required even if a LOMR or LOMA is pending. Record retention. The bank should retain sufficient records in compliance of compliance during the term of the loan. A standard flood hazard determination form must be retained provided the bank owns the loan, and the bank must retain a record of receipt of the notice of the SFHA for the period of time the bank owns the loan. Enforcement. Statutory penalties of $385 per violation, up to $125,000 per lender per calendar year. A potential of negligent liability if the lender does not comply with the act and the borrower's property is damaged or destroyed in a flood. That can be very significant. Fear penalties are your usual $7,500, $37,500, and $1.375 million. And there is administrative enforcement that regulatory authorities must examine for compliance with the flood insurance laws during each exam that is required either annually or every 18 months.